Hello, my name's Dio Hare. There's 5 things I look for in a share. A simple story, good cash flow, limited downside, potential to rise 50% in 2 or 3 years, and confirmed by the chart pattern. So I'm talking about Halfords at 275p. The market value is 550 million. Forecast PE is about 9 times. EV is about 5 times, and a yield of just under 3%. The stock rack figures are good. Quality 74, value 96, momentum 87, and overall 98, and it's a super stock. So what do they do? Well, Halfords is the UK's leading provider of motoring and cycling products and services. Motoring is about 66% of sales, and services is about 26% of sales. I see Halfords as a portfolio of businesses and opportunities. It's got about 444 retail stores, and with that, it has 20% market share of the motor product area, but this market is in long-term decline. It also has about 20% market share for cycling product, and this is a growth market because of e-bikes and e-scooters. It has 370 Halfords auto centres and also 91 mobile vans. So this is servicing cars. It only has a 2% market share, and they see this as a big opportunity because the market is highly fragmented. In cycling services, it has about 8% market share, and again, with higher bike ownership and electric mobility, sees this as a growth market. Interestingly, it also has a specialist website for high-performance cycling, a website called Treads. So looking at the history, for many years, Halfords chugged along with about 1 billion of sales and 80 million of operating profit. Debt was very manageable at about 100 million, capex under depreciation, earnings per share were about 30p. They paid a gradually increasing dividend towards 20p, and also reducing debt from about 1.5 times EBITDA down to about 0.8 times over sort of 10, 15 years. And between 2004 and 2019, broadly speaking, the price fluctuated between 260 and 500p. 2019, then operating profit fell from 80 million down to 50. Now debt of 100 million looks high, with EPS falling, the dividend became unsustainable, the share price started falling down to 150p at the early start of last year, and reached 50p in the early stages of the pandemic. As I see it, I think there's 5 reasons why Halfords is in a better situation now than before the pandemic. Firstly, there's a new and highly skilled new management team. Secondly, climate change will drive electrification, and with technology also increasing complexity of both cars and cycles, this supports growth in the sales and their services businesses, both for motor and for cycles. Then, tough economic conditions mean there will be more cars greater than 3 years old, which also will require more services. And Halfords have had a huge one-off pandemic benefit, moving from debt to a large cash position, which will allow them to consolidate the auto centre market. Cycling has become more popular, which supports cycling services, and post-pandemic, they can rationalise their property portfolio. And also it's supported by a very clear head and shoulders bottom chart pattern and a very positive uptrend. Sorry to overrun on time.